What's going on, folks? Welcome to the channel. And for those of you returning, welcome back. Today we're going to be talking how to avoid taxes legally. Before we jump in, I just want to say I am not a tax professional. This is not tax advice. This is not financial advice. If you are seeking tax or financial advice, please consult with a qualified tax or financial professional. What I'm about to share with you is simply information that I've gathered over the interwebs and from reading some textbooks that I thought would be beneficial for your information. That said, let's dive in. So, taxes. I'm sure we've all been there at some point or another, wondering, how do I pay less taxes? Well, unfortunately, if you are like most people with a 9-to-5 job, you can't. What I mean by that is there's very little you can do to avoid federal income taxes, state and local taxes, Medicare, Social Security. Most of the times, if you have a W-2 income, you just can't do much when it comes to avoiding taxes. Okay, so you're probably thinking, well, John, I keep seeing these articles of the 1% or the 0.1% being able to pay less taxes than those in my tax bracket or lower. Why is that? These people are potentially making 7-figure incomes, and yet their tax burden is less than the person making $50,000? Well, it's not so much as they're sheltering. It could be a little bit of sheltering, but more so because that they have qualified businesses that allow them to expense and deduct and do what might seem really complex and fancy, but really is relatively straightforward. And I'm gonna go ahead and share with you all some of those tips and tricks. I am a huge proponent of real estate investing, bar none. Now, there's an argument to be made for equities, there's an argument to be made for crypto, but for me, I personally just am all in on real estate. In the eyes of the IRS, real estate income is known as passive income, same as securities. The difference is, though, with real estate income, you can take this passive income and any deductions from it and actually deduct that against your active income, which would be your W-2 or 9-to-5 job typically. What I'm not saying, though, is you should buy real estate purely for the passive loss deductions, because that would mean you're losing money year on year, and that's just a terrible way to run a business. So don't do that. So let's go ahead and double tap into some of those strategies. The first one, which is the most powerful in my opinion, and the one that I love the most, depreciation. Now, what is depreciation? Depreciation is simply this idea that some sort of asset loses value over time. And in the eyes of the IRS, when this type of asset, whatever it may be, whether it's real property, say for example, the building that you've purchased, or personal property, such as appliances, as it loses value over time, you can take that value and deduct it against your gross rental income. So here's an example. Say you bought a single family home and the building itself is worth $275,000. Now, when it comes to residential real estate, you depreciate that using a straight line depreciation method over 27.5 years. What does that all mean? Take 275,000 divided by 27.5 and you get 10,000. You have to now deduct $10,000 from your gross rental income year over year. Off the bat, you have a deduction. You haven't done anything. You haven't spent money necessarily to fix anything. You've just purchased a property, and now every year the IRS mandates you must deduct $10,000 from your gross rental income. And it's one of the most powerful deductions I think that are out there. The second is known as bonus depreciation. Now, there's some variance to it, I'd say administration to administration, as to how much there is, but the idea of bonus depreciation is not having to wait the entire lifespan of that property to be able to deduct its value. With bonus depreciation, as it's in its current form, you can actually take 100% of the value and deduct it in year one. So say you bought a $500 refrigerator for one of your rental units. Instead of having to deduct $100 over 5 years, because that's the useful life of a refrigerator, you can actually deduct $500 in year one. A third tax benefit from real estate is just all the operating expenses you have from running your rental property. So for example, if you need to hire a plumber or an electrician to come in, you can go ahead and deduct those expenses. If you had to go to Home Depot yourself and purchase supplies or do a little paint or whatever it is for the general operating expenses of your rental business, you can actually go ahead and deduct those expenses every single year. The fourth one I think is amazing, actually comes as a result of the last tax cuts. So this is known as a 20% pass-through deduction. It's amazing. In short, what it says is, if you have qualified business income, you can deduct 20% of that from the net income. How amazing is that? That's incredible because when we think about deductions, it's usually because you had to go ahead and pay for something, right? And you're able to kind of recapture a little bit of that value back. But this is quite literally saying, thank you for making some money. Please keep some of this money and don't pay us any taxes on it. It's amazing. With all this being said, let's go ahead and check out an example. This is a two-family property I found up in the East Coast, specifically the Northeast. This is a pretty straightforward table, and we want to walk through these examples at a really high level. But here we have the gross rent. This is simply how much rental income you're generating every month multiplied by 12, about $51,000. Next, you have the principal. So this is how much you're paying against your loan balance. And then these are the interest, taxes, as well as insurance you're paying to the bank for the mortgage. So if you take $51,000 and you subtract out these two numbers, this is what you'd be left with at the end of a year. Not bad, about $10,000. Obviously, let's say that you had some operating expenses throughout the year of $7,000. So truly, this would actually be your net take-home amount. After a year of holding this two-family, you're looking at about $3,200. Again, not terrible. So you expect that that's going into your pocket. Great, but is that what you're taxed on? The answer is no, because remember what we discussed earlier about building depreciation? So the building is depreciating over time, and what that allows you to do is actually deduct that depreciating value year over year. In this case, this building is calculated to lose a value of about $17,450 year on year. And so by subtracting that from your taxable income, you're actually left with this number. This is your net taxable income at the end of 1 year. This is what you pay taxes on. Now, that's pretty incredible. And if real estate is not your only job, and say you had a W-2 job, you can take this negative $1,470 and actually deduct that from your W-2. So that's what I'm hoping to be able to drive home in this example, right? You get $3,300 in your pocket, but yet you actually don't owe taxes on any of that. In fact, you get to deduct this amount from your W-2 taxable income. And now you're starting to see how holding real estate investment can really be beneficial from a tax perspective. Though again, I'm not a proponent of constantly running a model like this because, you certainly want to be able to have your expenses in check. This is just an example that I wanted to highlight to be able to drive home the point of the tax benefits of real estate investing. This will go ahead and really help drive home the point. So thank you for tuning in. I hope that example showed you how you might be able to save $5,000 on your taxable income. Again, this isn't something far-fetched. You don't need to be making a ton of money. You just need to be able to have the right strategies in place to be able to take advantage. Appreciate all of y'all for tuning in. Until next time, peace.